Well, Alex, good to see you, buddy. Why don't you kick us off, man? I mean, obviously BHB Fund is invested in you, and we're like serious fans. I'm at least humble enough to damn sure know the people that are smarter than me. So, why don't you kick it off, man? You got such a cool background and all the things that you've done, and kind of talk about what you've been setting up.
Yeah, totally. So maybe I'll go in reverse order and talk about kind of where we're at and go back from there. So today I'm the CEO and founder of Stablecore, and before that I was over at Coinbase, and so you guys are probably familiar. And was there for 3+ years at Coinbase, and led a handful of teams over there. First, was on a team called Finhub, which was interesting that they did all the kind of orchestration and ledgering across the entire company. So if you think about kind of what Coinbase is at a high level. I mean, on one side, it's kind of crypto and digital assets, things like custody and wallets. And on the other side, it's banking and payment rails all over the world. So in the US and ex-US. And so they had to build what was effectively like a banking core inside Coinbase. And so that did all the ledgering, all the orchestration, and really helped run that business. I mean, you think about all the things, there's obviously like the apps that run on top, but there's also things like compliance and accounting and just all the operations, things like customer service and all the data that you need to have, things like account balances, transaction history. Again, so it kind of functions very similar to a core. So I was on that team for a couple of years, and then later ran the Coinbase Wallet developer team. So Coinbase is a separate self-custody wallet called Coinbase Wallet, and so I led that developer team there for about a year or so. And then finally, I was on the retail consumer side, so working in the actual Coinbase app, which is sort of the main app that most folks kind of know about. So overall, it was a kind of 3-year tenure, 3+ years tenure at Coinbase was really great. Worked with a lot of great folks there. And then before that, I was a co-founder of a company called Zabo, which is basically Plaid for crypto. I'm sure your audience is familiar with like Plaid, Yodlee, these guys, these kind of crypto data or these kind of financial data aggregators. We effectively did that for crypto accounts. And what happened, and we started that in 2018. And what had happened is, as the number of crypto accounts went from basically zero to kind of hundreds of millions, you had all these different services, like personal financial management tools, kind of fintech companies, tax and accounting software that needed to get access to data, things like balances, transaction history. And they had all these users that sort of had these accounts. And so that's, things like Coinbase and Binance and Kraken, sort of the exchanges, but also all these wallets, which had gone again from zero to kind of hundreds of millions of those. So we helped bring all that together in kind of one single API, kind of similar value prop to Plaid. And so we built that business between 2018 to 2021 and then ended up selling it to Coinbase. So that's how I kind of ended up at Coinbase originally. And then before that, I had more of a kind of traditional finance background. So I did investment banking to start my career, and then later private equity. So did kind of M&A for call it 5 to 6 years to start my career, and then had some things in between there. And got interested in digital assets around 2015 when I was leaving private equity. So it's been a decade or so. That feels like it's been about 100 years, to be honest. But yeah, so I've been building in this space for a really long time, kind of across multiple companies. And it's been quite the journey. So it's really fascinating to see kind of where things have gone, and just how things have accelerated. And maybe to kind of link it all to Stablecore, what I'm working on now. I mean, if you go back to 21 to 23, really, and there's actually a lot of banks back then that were exploring, digital assets and crypto generally. So I'm sure you guys are familiar with like NYDIG's effort. They had, I think, 20 or 30 banks that were doing Bitcoin buy sell. There was USDF consortium, which was doing kind of a proto like tokenized deposit stablecoin that I think they had 15 to 30 banks or so. So let's call it, 40 to 60 banks in the US that were actually working on this stuff. I think, Coinbase was working with PNC back when I was there, I think 21, 22 timeframe. And of course, what happened is post FTX, post signature, Silvergate, kind of all that. That was kind of the meteor from outer space that landed and brought really intense political and regulatory scrutiny. Some say that was politically motivated, but for whatever reason, all those efforts got put on pause, really, and everyone got stopped, whether it was things like Bitcoin, whether it was things like stable coins. And what happened was banks were effectively put on a kind of uneven playing field, I would argue, where fintechs and other kind of crypto companies could do this stuff, but banks effectively couldn't. And that was really the state of the world until late 2024, when there was a change in the admin, and we had a change in sort of regulatory apparatus. And really, since the beginning of 2025, there's just been absolutely tectonic shifts, I would say, on the sort of banking regulatory front, right? And just many things. So there was There was the digital asset executive order, which did many things, overturned SAB 121, which is this sort of kind of arcane kind of bulletin that the SEC put out that really kind of prevented public banks from getting into crypto. That same executive order, mandated that the various agencies go look into, digital assets to make U.S. sort of the crypto capital of the world. And so from that, you had things like the individual banking regulators who, from the 21 to sort of 23 era had put in place these really tough kind of guidance about like, supervisory, not objection. Basically, if you're going to work on this stuff, come tell us. And it was effectively just a hard stop. And so and I think it was the OCC on March 7th, the FDIC on, I think, March 28th, and FRB on April 24th, I believe, had all taken their prior guidance, said, hey, we're actually going to rescind that. And we're issuing new guidance that says these are actually, permissible activities for banks, things like custody, things like stable coins, other digital asset activities. And so I think arguably that was really the kind of starting gun, I think, for many banks, including ones that had worked on things back in 21 to 23 who'd gotten stopped, where they said, okay, the sort of regulatory picture has finally changed. We're finally on this even playing field. And that was just, again, a huge tectonic shift that happened. The other really big thing that's happened, which you guys are probably familiar with, is things like the Genius Act and the Stable Act in Congress, which are formalizing the kind of rules around stablecoins in particular. So if you kind of sort of take all these things in aggregate, what's happening is that banks, again, for the first time, really can play on a more even playing field with the sort of fintechs and the crypto companies of the world. And the kind of core problem, though, is that nothing in the bank technology stack really supports this stuff, right? So we look at the banking cores, we look at all the digital banking providers, really just the sort of banking tech stack in general. Because banks haven't been able to be in the space, there hasn't been anything built around this, right? On how to support these things like stablecoin payments, things like Bitcoin at the bank, things like digital asset-based lending. And so there's this giant gulf between the sort of existing tech stack for banks and the sort of crypto tech stack, which includes things like the custodians, things like the stablecoin issuers, compliance tools. And so you can think about Stablecore, my company now, as basically filling this gap in between these two sides, right? So we think of ourselves almost like a digital asset core or digital asset side core, maybe more accurately. But what that really involves is on one side, we're bringing together all the digital asset and crypto infrastructure. So things like custodians, things like stablecoin issuers, things like compliance tools, putting that all together in a package on one side. And on the other side, integrating directly into the existing bank technology stack, right? Things like banking cores, things like digital banking, and really meeting banks where they're at and not saying, hey, you have to change all your core infrastructure, or you have to make all these just crazy changes. But how can we find a way to take this new kind of ecosystem and embed it in where you actually currently are? And what's interesting is that kind of exercise of bringing these two pieces together involves doing things like orchestration, like ledgering, which is very similar to the type of work we did at Coinbase. And what's also interesting about it is that if you kind of squint, you see that the problem that banks have is really the problem that Coinbase had as well, right? Where Coinbase on one side was crypto infrastructure, on the other side was banking and payment rails. Now it's the same thing with banks, just in reverse, where they have the banking and payment rails. They're trying to add the crypto infrastructure, but you kind of need all these pieces in between to actually run the business, right? Things like operations, compliance, accounting, all the sort of apps that you want to build on top, all the experience you want to build on top. And so I think being at Coinbase and building this at really, really massive scale was a very kind of key input into realizing that, a lot of the same infrastructure is going to need to exist on the banking side. So, yeah, that's, I guess that was a long-winded answer, but that's a little bit about me, about the company. We've got, great, I've got two other co-founders who are amazing. They're also former founders, also have had former exits. So we've put together a really kind of stellar team to work on this.
I'll tell you what, I don't know what it is in our industry where we run into a brick wall at 100 miles an hour and we're like, we'll never do that again. And nobody tells anybody that the brick wall's gone. You can actually do that now. And then the reluctance of everybody to do that puts them behind. And this is one situation where, I tell people this, all the lobby and all the dollars in the world don't do the good of a change of administration and their approach to regulatory aspects of everything that we do here. And for any banker out there that's like, what in the hell are y'all talking about? There's an alternative system that looks a lot like the system with cards and payments and banks and cores and money movement and wires and Forex and everything else. But it's over in this other place that works on a different tool set. And this other tool set is one of the things I want to point out here to everybody is the friggin' complexity of this, because it's completely different. Think if you didn't know what a gateway was, or you didn't understand exactly what an API was on an interface to a third party that attaches to your core. These things are very complicated and they're very different. And so you guys, right place, right time, absolutely the answer, perfect. And everybody sees that. I mean, you guys are blowing up like crazy. It's one of the reasons we want to tickle to death to be a part of it. But the idea that if you were a banker and you think about, gosh, I understand wealth management. We have a whole outside party that we work with, and you can go in and move money from your account and you go buy Tesla stock or whatever it is you wanted to do. That's exactly what's going over here. Now, these worlds are going to be combined. And that combination is not something that you can wait around on. And at the same time, everybody's like, well, we're going to have a stable coin. We're going to, everybody coming out of the woodwork with their stable coin now. Well, how do we get our own stable coin? What's important here, and tell me if I'm right on this, is that you can work with all of them. Not whether you have one or not, it's whether you're compatible, so to speak. That's what you guys do, is the intercompatibility thing, and being able to say, look, just call your core. They know who we are. We're going to call this up for you. Fair statement?
Yes, absolutely. That's right. And just to your point about it being an alternative system, I think that's absolutely right. And I would even say that, every once in a while you have these transitions in tech, like in banking and other industries, right? So in banking, it was going from branches to online and then online to mobile. And this is just yet again another one of these platform shifts, right? That's happening. And I think the way that you lose in these platform shifts is not shifting with it, at the same time. And yeah, so to your point, and there's supporting stablecoins, supporting digital assets at a bank, it doesn't mean, becoming Coinbase or somebody like Robinhood, tomorrow. What it means is that there's an enormous amount of these assets that are out there. Like if you're talking about something like Bitcoin or crypto, it's like already in the trillions. If you're talking about stablecoins, it's around 250 billion. And it's projected to grow to something like 1.6 to 3.7 trillion based on Citi's reports. So we're talking about these massive kind of multi-trillion-dollar asset classes. And I think what's going to happen is that the banks that support these, and sort of even if it's just support basic interoperability, right? Just support the ability to take these stablecoins and convert them into deposits, or take deposits and send them as stablecoins as a new financial rail. I think the banks that do that are going to be in a really amazing position to kind of serve their customers. And the ones that don't, I think, are going to miss the sort of platform shift that's happening. And they're going to be the ones that are hurt by it. But I think the important part to know is that, again, it's not like you have to become Coinbase tomorrow. I mean, there's a way to sort of just support the rails, and it's kind of the crawl version. And it doesn't involve you becoming a kind of crypto custodian. It doesn't involve you doing a bunch of kind of trading. It's just sort of, getting the basic payment rail of stablecoins, for example, and having the basic interoperability at the bank. And that's a great starting point. And then, once you do that, you've kind of got the primitive embedded of like, hey, I can go from dollars to stablecoins, for example. Now you can look across the rest of your business and say, hey, where does this make sense? Does it make sense in treasury management? Does it make sense in cross-border payments? Does it make sense in, things like merchant payouts? Does it make sense for my kind of banking as a service platform, which it probably does, given the number of fintechs that are looking at this space. So that's how I would think about it, is sort of, crawl, walk, run, and what's the crawl version to get started.
Perfect.
That's a great thought. One of the things, man, I wanted to kind of ask you about this. So, distinct from bank vendors, let's say the other fintech, right? This other world we're talking about. I have really noticed over years of, working and playing either with those folks or in that space, that the concept of cores and ledgers and batch and time value is just, I don't want to say lost or missed. They're probably right and we're all wrong. But everything's hot, real time, right? And so you have these fintech folks that show up and they've been doing what they've been doing, and all of a sudden it's, hey, let's come play on the bank side, and they don't have a ledger. They don't see the need. They actually adamantly disagree, right? That there should be one. Everybody should, if you're just a part of the ecosystem, connect to everybody and move everything real time. Reg, compliance, fraud, all of the things that I think we all maybe understand too well on this side. And so I just want to get your thoughts on that, man. Do we all, in our shift and move to real time, from payments rails to a lot of core upgrades going on, et cetera, do we all move that direction? Does that maybe have a little bit of a pause and come back to maybe we do need a little bit of time value? And what do you think? I mean, is this tomorrow? What do you
Yeah,
think?
yeah. Well, so I do think that there's more broadly a pretty unstoppable march, probably over a really long arc of time, like towards 24/7. And I think, and I think that stable coins in particular are going to drive a lot of that, and potentially tokenized deposits. I'm sure you guys have seen JPMD, what they're working on there. We can have a separate conversation about stable coins and tokenized deposits. Don't want to get in the weeds on that. But in short, I do think that we are generally going to move towards real time. But I think one key insight we have and just the sort of reality on the ground is that that's not the way it is today. And a key part of our business and our approach, working with banks is that, you have to meet them where they are. Like you can't just drag them kind of kicking and screaming. There's a middle ground here where, you can have these assets, you can support things like stablecoin rails, you can support things like Bitcoin, but you can do it within the existing model. And that I think when you have that middle state that's not just like, hey, let's just skip everything and go straight to 24/7 and sort of break all the rules. But you have this sort of middle state where it's like, okay, let's meet you where you're at. And this is actually a transition. To me, that's the right kind of gradient to go across, right? From like where you are today to your sort of next step where you have the sort of old gen and the kind of new gen in one sort of sitting. And then from there, you're in a good spot to say, okay, if this goes full 24/7, if this goes full kind of modern, that's great. But again, you sort of have a logical transition. I think where you get in trouble is where you jump from the first one to the very last one when it's not ready, right? So that's just sort of my general view. But I think also to your point, like there's a reason for latency and time in some of these systems. Like it's not just
Oh,
all
yeah.
about like doing, as many transactions as possible, as fast as possible. So I do think that one challenge that kind of blockchain-based rails, so things like stablecoins, things like tokenized deposits, something we've had to figure out, in crypto at places like Coinbase and others, is how do you sort of selectively introduce time into the process where it needs. So it's kind of 24/7 minus, and the sort of minus is the process, right? So I think that's the Goldilocks zone is introducing time and process where it's needed, and not just speeding things up to just break everything else. I don't think that's the right approach.
Dude,
On
I
that,
tell you what, man, that's great. That was perfect. That is the part I want everybody to understand and everybody to hear here. This is first off, the assumption being with the Genius Act, all this being passed, we have regulatory, guidelines, we have regulatory authority as well. You got state and federal regulators on anything related to these things. This is not willy-nilly, Wild West stuff anymore. It's going to be done the right way, and it's going to be done in a way that allows things. Now, the other thing I want to say, and this is a shout out to all the dipshits in the world. Shut up. Golly, man. I mean, I've read it's the end of the world as we know it, and it's the only way to go in the future, and you should act immediately. And it's like, well, which one am I supposed to go to? Where's the line for the end of the world, or where's the line where I have to go tomorrow? And everybody, I think, needs to calm down a little bit, understand this, take the time, listen to things like this and understand from real experts, not pontificators. I'm a pontificator to a certain degree. That's why I wanted to talk to you. But to learn these things and understand that it's going to have regulatory guidelines, it's going to be doing things differently. It allows you to stay within your box, and we're bringing it to you, not you have to go out and do something here. If that's the case, well, shit, there's about 4 banks are going to win the game. The game's over. What we got to do is bring this to the bankers. That's what you're doing. This is perfect. It'll come through your core. All that's already happening. I talked to a core right before I got on this call that's dying to talk to you and get these things going. This is the process of how we integrate this into banking. And there's always the banker that's like, I don't have an online onboarding process, and nobody ever asked about it. And it's like, no shit, because you don't have one. So there's things like that maybe you're not getting asked about this because you don't have those customers yet. And that's an opportunity zone for you, not something to be going, gosh, we don't get that. The other thing is there are so many of these things, whether it's, I don't want to digital only banking, or whether it's, BaaS banking, or whether it's opportunity zones like this and stablecoin. These are not the things you want to run from. These are the things you want to lean into a little bit, because it totally changes banking and what your capabilities are in the future. And I've been here since 1910 and this, and I bet you have electricity. I bet you have telephones. I bet you have the internet and all kinds of things that weren't necessary at that point in time. And you think about turn those off today and you'd be like, I can't run my bank. Think that way. This is where we're going here. And you have to see these things for what they are at the moment in time. I think you used the word earlier, a tectonic shift. You know, this is, guys, I mean, we're throwing the ball now. We're not just running the ball up the middle of the, wishbone anymore. Spread offense and put 50 points on the board. You better learn that offense. You can't play any other way. And you also need to see this as, man, this is the greatest opportunity. Thank you. Now I can get into this thing, really understand how to make money and make money in multiple different ways. And I've screamed this to bankers so many times, so has Tanner, about using your charter and the regulatory burden of all that as a moat.
Yeah.
And everybody wants to play and everybody wants to get into that. What do they want to do? Steal my customers? Only if you let them.
Yep. For sure. Yeah. And something that we have a lot of conviction around is that it's like the reason that banks haven't been in the space is because there's been this uneven playing field. But now that it is level, I mean, the vast majority of customers, whether retail or their business, would have loved to done this business at their bank, right? You've had all these really large companies that have grown, and by the way, they're great companies. You know, folks like Coinbase, Circle, Bridge, which was recently acquired by Stripe. There's like many examples. These are amazing companies. They've got great people there. They've sort of done the right things, but part of the reason that they've gotten so large is because there was basically like a kind of void where banks didn't play in the space, but now that they can, so many of these customers would actually prefer to be at their bank, right? They would have originally, if they could have bought Bitcoin at their bank, or they could have sent the stablecoin payment at their bank, they would have done it. The problem is that they couldn't, but now that they can, they will. And so, to your point about opportunity, I don't think like banks have this amazing advantage, which they are their kind of primary financial account for their customers. They have the trust, they have the sort of regulatory moats, they have all these very important pieces. And that's part of why we focused on banks and we focus, only on banks, is because we saw that once this regulatory picture changed, that they actually have the best competitive positioning. And they don't really even know it is the thing, but I think they're starting to learn it. And so yeah, so I just fully agree with this idea that this could be a huge opportunity. It's not all doom and gloom. And again, I would just go back to what I said earlier. I think the only way that you lose is if you just don't shift with the transition that's happening. But everyone has that opportunity to do that now, especially given the regulatory changes. They're saying, hey, these are permissible activities, things like custody, things like stablecoins, things like digital asset activities. And so the sort of regulators have finally gotten there. And now the next action is for the banks themselves to sort of do something about it.
Me and Tanner were laughing earlier about how many people in the last month have asked me if I know you, or how many people have said, yeah, we're talking to these guys. I'm like, unbelievable. It's like everybody is just going straight to you. I mean, Dan?
Good timing. So I have one. My good buddy Steve at Next Moves, talking to him a couple of weeks ago. He came to visit, him and Walt, and we're sitting in the river, Alex, might have been having a couple of beers and talking through some of the new rails and the new ways of doing things, and kind of a head scratcher. Some things just get wildly adopted and some things maybe they get there, but it's like, I didn't think that was going to take 10 years, and he kind of sat there and he looked over at me and he said, rules. He's like, why do you think the Visas of the world, et cetera, are just, so critical infrastructure? And he's like, because there's rules. All of us think smart contracts, right? We all are in a position where each person that is a part of the transaction can trust a party who will have rules and enforce rules on all of us, right? It's like a structure. And that really, really grabbed me, especially with your point of, and I can imagine the excitement from you guys, the dates, right, of each thing that happened, watching all of that fall into place, now we at least have the semblance of rules and governance and these things beginning to happen. And that's funny enough. I actually think of you guys on the banking side. I liked we'll call it stablecoin sidecar, right? I like that theme because you kind of fit as a critical piece of that infrastructure as well. So will you talk a little bit about the rules thing and where you think all that goes here?
Yeah, so I mean, in terms of rules and sort of smart contracts, I think that's one of the sort of kind of killer use cases, killer features of blockchain technology generally. And I think it's helpful for people just to remember that this, if we take just something like stablecoins, I mean, this is a market that grew from literally zero less than 10 years ago to now trillions of volume, like because sort of annualized volume. And so it's just remarkable. Like how did that happen? I mean, if it's not the fastest growing payment rail ever, it's probably certainly in like the sort of top three. And there's several things that contributed to that. One is that we should just acknowledge that there were these kind of giant crypto markets that emerged as well that also went from zero to trillions. And then all of a sudden you needed this kind of US dollar denominated medium of exchange that could be 24/7, that could be borderless. But there were two other important two important other characteristics. One was that it was completely open, so it had this sort of network effects that could grow extremely quickly. And the other one is that it could be programmed, and it could you could have these rules, you could build all types of different things out. You could build this sort of entire, kind of alternative financial system. Doing things like smart contracts, and then using that logic. And so I think what's happening now, what's interesting is now all that is sort of coming into TradFi, right? And so that's the logic behind things like JPMD and all these tokenized deposits. And the same with stablecoins as well, right? And so what you're seeing is this thing worked kind of in DeFi, in crypto at really large scale. And now that we have this regulatory, kind of clarity, now that same logic and that same openness and that programmability is now going to come to TradFi. It's going to come via stablecoins. It's going to come via tokenized deposits. And that's why you have, folks like JPMD and folks like JP Morgan that are investing so heavily in pushing this. And so I think that's going to be a real kind of killer feature over some of the traditional rails. Like I get asked sometimes from people like, well, isn't this the same thing as kind of like RTP Fed now? And there are some similarities, but some differences is one, things like stablecoins and tokenized deposits are global by default, so that's a huge value. B, they're kind of way more programmable as you mentioned. And then another thing that I think that falls in the sort of programmable bucket that people don't think about as much is that it's also a rail that has both money and collateral. And that's actually really important. And if you look at the adoption of how stablecoins grew so fast in crypto, that was a huge part of it. Again, because they need this dollar denominated asset that could sort of trade atomically with all these other assets, like within crypto. And so as you have tokenized assets coming online, so tokenized securities, tokenized credit, tokenized treasuries, things like that, you're going to see just an explosion of usage because you have this rail that's 24/7, that's global, and the dollars and the collateral are on the same rail. And that's really fascinating. And it's a really kind of killer use case and feature. And by the way, that's why, JPM is settling like something like 2 billion of repos or whatever a day or whatever it is. And I think they're making such a big investment. And, so what I think will happen is that as the kind of, all the money and all the kind of collateral comes onto these networks, they're just going to get larger and larger and larger. And they're going to become even more differentiated from the existing rails because of that. So yeah, but Tanner, that's where it comes to mind to your question.
You brought
Well,
one
I
up.
mean, if it wasn't a true thing, there wouldn't be such a Visa stack. Why do we have Visa stack if we're not moving this direction? They're scared to death, right? I mean, all of the major players in the traditional payment areas, they see it plain as day and have already acted on that. They want to play in both worlds.
But
Yeah.
man, you just like rolls right off your tongue, right? JPMD, and it's like, oh, I'm thinking back. I mean, many years ago, watching all the precursors and everything that became Zelle. And I remember the conversations at the time. I'm like, is this going to actually happen?
For sure. Yeah, I definitely think there's a setup here. And then there's been a lot of discourse like, around Genius around, well, this is going to disintermediate community banks. You're going to have deposit outflows. I kind of have a counter view to that. But I think what definitely will happen, I think if community banks and kind of various mid-sized banks don't sort of enter the game is, yeah, I mean, the sort of big guys are going to push ahead on this, right? And so you may have a world where it's kind of, the really large banks, driven by like JPM and others. Then you may have big crypto. I'm sure you guys saw it. I think today it came out that Circle is getting a bank charter. And we definitely like the folks at Circle. We like the folks at Paxos. And I think that, makes sense. It's in their interest. But there could be a setup here where it's big bank, big crypto, and then sort of mid-sized and community banks. And if mid-sized and community banks don't sort of do something here and start building in this space, they're just going to become order takers from all the other guys. And from talking to a lot of bankers and talking to a lot of community bankers, I don't think that's an outcome that they necessarily want, right? And so yeah, I do, Tanner, to your point, I do think there's an imperative to actually get in the game. And the good news here is that everyone is sort of starting on the bank side at the same line, right? It's not like It's not like, all the big banks have some massive advantage over the little banks here in terms of timing. Now, the sort of non-banks had a huge advantage, like we talked about earlier, right? They had this uneven playing field where fintechs could do it, crypto companies could do it, but banks couldn't. But, as of March and April of this year, banks can play in this space. So there's really nothing stopping kind of community banks or even kind of regional mid-sized banks from really participating. So I think there needs to be some cooperation there. And certainly we're kind of working with some groups that are kind of trying to kind of do that and marshal that. We definitely believe in that.
This is what's so important with you guys coming in on these things. I'm a little different than everybody else. I reasonably have a good perspective on, where we're at and where things are heading and the innovation side of community banking. Been doing it a while, a few successes, couple of stumbles. But I'm not as hard on community banks as a lot of other folks are. And to be honest, I think it's bullshit. Bankers must. And it's like, how, man? How are we supposed to pull that one off? What we do need, though, is the critical infrastructure to community banks, right? And that is a problem that I think we're all responsible for. Think us, bankers helping bankers, and the fund and everything we do there, investing in awesome, cool things. And I think community banks jumping on board in any way to participate in helping our own future to be created. But that doesn't mean I don't think a bank needs to go build their own, all of the things we're talking about, right? We need you, in community banking. And I think that is something we'll have an impact on. So anyway, just a shout out to you, man. We appreciate you and all of your hard work and effort, and you guys are doing damn good.
That was perfect, Tanner. I mean, look, I don't need to build it. I don't need to do all these things. I need to call my core and say, hey, can you get me Stablecore and Alex Trecee, right? If not, call Alex. He'll help you out. Now, the other thing of this, that's a big, I'm going out on a limb here and saying bullshit. What you need to do is take 50% of your capital and hold it in a stable coin. What kind of dumbass even thinks that way? Of course, you don't need to do that. This is just look at it like I've been driving along the side of the freeway. Where the hell is the entrance ramp? This is the entrance ramp. Okay. You don't have to do anything. You don't have to buy a Formula One race car. You don't have to do all these things. You don't have to invest your capital. You don't have to do much here to be able to say, I'm in the game now. Okay. Guy like Tanner shows up. He's ready to go. You're in it. All right. How much? Let me ask this. I want you to help me explain to everybody and help me understand. Why do I not need to put 50% of my capital in stablecoin?
Yeah, well, I mean, so there's basically three different support models for stablecoins, right? Like option A is go issue your own. That's like, bank coin A. Option B is join a consortium. And so there's kind of things like Global Dollar Network, which is more of a fintech consortium between like Kraken and Robinhood that's out there. But that's a single issuer and that has many members. So some folks may be more familiar with that model. And then there's a third model, which is just support the payment rail, like just support all stable coins. You don't necessarily have kind of, a particular stablecoin that you're backing, but you're giving your customers access to the rails. And this is really like the kind of 80-20 option. I think for the vast majority of banks, option A doesn't make sense. And in fact, it's been interesting. I mean, there's been some super large companies like PayPal or just really well capitalized companies like Ripple that have tried to launch their own stablecoins. And they've shown just how hard it is. And if you look at all the relevant data, so things like supply, things like volume, it's still 90+% Circle and Tether. So Circle is the dominant US kind of issuer, Tether is the dominant ex-US player. And so despite the fact you have these sort of infinitely capitalized companies that have tried to do it, it's still basically 90%, higher than sort of Visa, MasterCard concentration in this market. And that's because it's so difficult to break through the network effects and so difficult to sort of get liquidity all over the place. And they've been doing that for years and years and years. And so that's all to say that I think it's just really, really difficult to go at it on your own and build your own kind of stablecoin. I do think that the consortium model could make sense for banking, and I think we will see consortiums emerge, both kind of like more big bank consortiums, like other consortiums that are kind of mid-sized and smaller banks. And I think that's a model that should be tested. And but the one I would recommend the most, I don't almost kind of recommend them like in reverse order. We're starting with that option C of just supporting the rails. And then if that makes sense, then you can sort of explore a consortium. And then I wouldn't recommend doing a stablecoin issuer for almost anybody. But I want to hit on your point of like, in an ideal world, like let's take that option C, where you are giving the ability to send stablecoins from deposits. and you're giving the ability to take take stablecoins and convert them into deposits. I mean, that flow can be done without holding any stablecoins. That can be done just by orchestration, with dollars, right? With deposits. And I think some banks are kind of surprised to learn that. But yeah, you basically as a bank, and by the way, I think this is why tokenized deposits are having their moment, and this is why JPM is sort of pushing tokenized deposits, because tokenized deposits potentially kind of have the nice attributes of taking some of the technical properties of stablecoins, which is like, they're on a blockchain, they're 24/7, they're auditable, they're on the shared ledger with other collateral, but they're still deposits from a regulatory standpoint. And so you can maybe have this nice Goldilocks zone where you kind of get the deposit treatment, but you also have the sort of nice properties of being on blockchain rails. And so the way I think that this will split is I think that stablecoins will be used mostly in orchestration for kind of more cross-border transactions where it makes sense, where you need non-reserve settlement. They'll be used in sort of fintech applications, a lot. But when it comes to the domestic US banking system, you may see that tokenized deposits and obviously regular deposits are just completely dominant. And there's not as much stablecoins there. But yeah, but to your point, you don't, to support stablecoins, you don't need to hold a bunch of stablecoins necessarily. It's more of a kind of orchestration exercise, and then obviously having the foundational tech capabilities to support it.
Perfect.
It's a cool time, really cool time because we're merging things together, and I'm starting to see that more and more. That, I mean, just think of how we all think about things. What's the currency? Okay, it's dollars. What rail? Are we going to wire it or ACH it, right? Where am I going to ledger it, right? And what's the regulatory look like? And, right? And how do we insure it? Or, what backs it, right? Et cetera. And now it's none of those things and all of those things in one thing. And we don't all know how to talk about it, right? Because it's 4 or 5 concepts. It's like 4-dimensional smashed into it's just, I can't even put it into words of when you smash all that together and now it's just called one thing. What? It's really, really weird time watching all that evolution come together. It's pretty cool.
Well,
Yeah.
Al Gore invented the internet and changed everything, right? So here we are.
Yes, yes.
Okay,
You guys are doing great, man.
Let's take a step back here, guys. This is important. Let's gotta really go to the next level at the same time, do it real slowly. So if you just walked in the door right now and said tokenized deposit, tokenized security, what in the hell are you talking about? Okay, so can you back up a little bit and talk easy for everybody to kind of understand what you're talking about? And I think the light bulb will come on of, oh, I see what this means now.
Yeah. So I think to answer this question, Dave, so it's helpful to talk about what stablecoins kind of are and why they're useful and kind of how they came into existence. And I can segue from that into, because I think it helps answer the question of like, why are tokenized assets useful? So as I mentioned earlier, originally you had this new market that emerged, which was crypto, things like Bitcoin, and it went from, zero to multi-trillions. And you needed this asset that could be a sort of dollar medium of exchange and trade globally and trade 24/7 because crypto is 24/7 and crypto is global. And so that's basically how stablecoins were born. And the way they did that is by putting those dollar assets on blockchain rails, which was the same place that things like Bitcoin were. So the sort of original invention were these assets like Bitcoin that were on blockchains, and that was sort of the new technology. And then the sort of next technology was, hey, using that same technology, let's put dollars on that thing. Let's put dollars on that blockchain. And then when you brought that together, you sort of had the global crypto markets. Now, what happened is as that became very large and as people started to see, wow, this is a way that I can send dollars anywhere. I can, if I'm a business in the US, I can pay contractors, I can pay vendors. All the crypto exchanges were moving tons of money around, through treasury management. They had bank accounts all over the world. And then it started to emerge into this is not just a way to trade crypto, but this is like a net new payment rail. And this is a net new technology. This is a new ledger technology that we can use to send dollars around, to send other fiat currencies around. And we can put the actual collateral on there as well to have the same properties that the sort of crypto markets have. And so when we say tokenized assets, what we really mean is bringing that 24/7 auditable and shared ledger to all the other assets and bringing and sort of bringing all the efficiencies, bringing all the programmability that we've basically seen in the crypto markets. So you can think of it almost like crypto markets were, and I know people, and especially bankers, don't love the sort of traditional crypto markets like Bitcoin, but one thing they did that was useful is they sort of proved the sort of product market fit of blockchain technology. What they showed is that hey, you can secure and transact in this multi-trillion-dollar capital markets here. And they basically did all that work. And it was like the beta version, right? It's like, hey, we sort of did all this work. We did it at really massive scale. And now the more traditional capital markets are saying, wait a minute, we could use this exact same technology and get the same kind of benefits, but we'll do it with all the traditional assets, right? So, but to answer your question just really firmly, what it means when we say a tokenized asset, like a tokenized security or a tokenized loan, is it means taking that traditional asset and giving it 24/7 capabilities, putting it on a shared ledger with money and also other collateral, and making it auditable. And what that does is it sort of massively lowers the transaction costs and also massively lowers the sort of surrounding cost of all the supporting infrastructure, compliance, accounting, all these other things, because you have this sort of shared ledger.
So before the euro, I'll slow this down even further for everybody. When France wants to trade a box of cookies over to Germany, it's like, well, what's your currency versus my currency? How much are we paying in your stuff or my stuff, right? And so, the dollar being the world currency, was like, cool, we have something in the middle. All right, think of it this way, that we didn't have that. But yet at the same time, now I want to take you a step further here. You remember when we had abstracts? We had all this, my God, the story's this long on a piece of property. This is just some house built in the 50s or whatever. They've torn it down and rebuilt it 15 times since then, but to move the titling of that thing is a mess. And then somebody said, what we ought to do, we ought to have a title policy. Somebody will go back and read all these things and condense it and say, okay, yeah, cool, here's where we are. And we're going to put a title policy on that. And then we have escrow and all these other things that we go through this process of buying and selling this property. Wouldn't it be more efficient if we had all of that just in a title that was a digital title that says this is proof, and going on from here, we'll tell the story digitally. That's a blockchain. All right. So think of the stable coin as, wow, it's the intermediary between the French and the Germans so they could buy the cookies. Got it. I needed that piece to be able to do this. Well, before this regulatory shift, man, they built the whole damn planet over here because they can play with each other, but they can't play with dollars. And so the stable coin issue is the bridge between the banking world and the crypto world in the way that the future is in the blockchain. The future is all of this because we don't want to carry around a damn abstract in my briefcase. Oh, now I can digitize all these things. We can make it safer. We can make it faster. We can do a lot of stuff here. That's why trillions of dollars have gone that direction. It's your dollars that haven't made it there yet, right? And so if you're catching what we're saying here, it's game on. There's a new day, a new place in town. We don't give a shit whether you have your own stable coin. Be able to be in this game. Like turn the internet on and, oh, wow. Now, where are we headed? We're headed to a moment in the future to where I can have let's say a title, an authentication of this is a Rembrandt painting. This is an escrow amount. This for this particular property and no other. This is a deposit that's on this apartment. All these things can be done way more efficiently with way less bullshit. And we're going to lose all kinds of icky things that are in the middle. Like you have to have a lawyer to be able to go to the title company to be able to buy it. I mean, man, buy the house for crying out loud. It isn't that hard. We made it hard. And what we've been trying to do for a long time is go from the pre-computer age and try to smash that system and blend it into something that works on a computer. It wasn't built for a computer. This system, it acts like it never knew what an abstract was. It doesn't know any of those processes. And it takes these new processes in an efficient way. Guys, is it perfect? Well, shit, the one we have right now is not perfect. So I'd say let's try it out, This is where it's going. We've been waiting on somebody to come along and say, you know what we need? We need state and federal regulators to step in when somebody's out of line. We need legislation to do that. And no, we haven't.
That's right. Yeah. And it's such a good point around just being digitally native. And I like your point about it's all it's ever known. And that's right. I mean, it was an entire system that was built for a digital native application. And that's, and so I think that's one of the sort of gifts, if you will, what, kind of crypto, sort of has given to us, is that was essentially the playground sort to basically
The
develop.
playground. That's a
Yeah.
great line, man.
Yeah. So
Yeah,
that I mean
great.
that and so yeah, it built this entire kind of digitally native system that was from the ground up, digitally native. And so now we get to take advantage of it in multiple ways.
You bet. Yeah, this has been such a cool conversation. I know we'll have 100 more. I can't say enough good things, Alex. And I also, I mean, kind of as I mentioned earlier, I think I've watched over a lot of years from the technology side of banking as a lot of our badasses have left and gone to, not banking focused. Now with the crypto world kind of coming back together, it feels like, okay, we're all on the same team again. But
Mhm.
it's really tough to watch, whether it's community banks getting acquired or technology bright minds being lost to other industries and things. And it's really cool when we get a new badass that comes to join us, man. So appreciate you and all you guys and everything that you're doing. Really excited to rock and roll from here, man. And appreciate you coming on the show.
Totally. Thank you guys for having me. It's fun catching up.
All right, man. We'll see you guys later.